Can you just give us the lay of the land as to what kind of environment Peloton's walking into?
Well, it's a tough one. You saw Bertha noting the decline. I mean, it's true. You got Pinterest is up nicely this overall, but this week these stocks are getting killed. Pinterest is down 10%, 12%. It went public in April. It's been all over the place. So Slack's at a new low. It's down 10% this week. Lyft's at a new low. It's down 10%. Smile Direct, remember, Smile Direct priced above the range. They priced $23, as I recall, was $19 to $22. It's $14 right now. And we're watching Peloton here, waiting for that to open here. There were some indications I saw earlier on Twitter, maybe at 25. We don't know. We have to confirm that and see what's going on here. But the point is, we're in a very tough IPO market. And my biggest indicator, the IPO ETF, a basket of the last 60 IPOs, big performer on the year, up 30%. It's down notably in the last several days. It's up 23% on the year, lowest level since February. So what we're seeing here is a pushback on valuations, pushback on companies that are not profitable. Peloton's still not profitable. And I think that WeWork governance issues, about different share class insider dealings, I think that's having an impact on some companies as well.
All right, Hans, let's bring you in as well. Peloton, big brand, big name, but I've got a problem with it. Maybe you can help me sort through it. And it's the cost of customer acquisition. I mean, here's a company, churn is so low, but sales and marketing costs roughly doubling every year, $324 million in the last fiscal year for about 500,000 riders. If churn is so low, word of mouth is so good, why do you have to spend that much on marketing?
Well, as you correctly pointed out, the churn is very low. It is a 95% retention rate. It's we just haven't seen anything like this before. But at the same time, as you know, the cost of marketing online, with Facebook, Insta, have all cross-board increased quite a bit. So I think partially it's due to the external environment, less so about the product itself.
Hans, on the one hand, you've got the subscription model that represents recurring revenue. On the other hand, you have these $2,000 bikes, $4,000 treadmills that tout strong margins, are lucrative, account for the vast majority of sales right now. From an investor standpoint, which one's more important?
I think for us, you look at the math, if you don't want to pay anything upfront, it's $58 per month for the bike for 39 months. So you look at that, $58 is essentially the cost of gym membership. So if you spend to split the cost of Peloton subscription with two people, it is a great deal, and it's part of the reason why people are buying it. And the experience is extremely unique and sticky. This is why you see the 95% retention rate after 12 months.
Bob, I wonder to what degree easy money in this economy is skewing business models. Because, I mean, with Peloton, I question, is this a niche company? Because it's like a $1,200 bike, right? And then a subscription after that. How many people can afford it? But they're spending all this money on marketing, acting like it's going to be a huge audience. And they can spend this money on marketing, I guess, because investors have given it to them. If they grew slowly, would the model look different?
Yeah, in fact, this was a lot of comments about the WeWork situation, overvaluation, a very, very long path to profitability. And we're now in a period where investors are pushing back against the higher valuations and companies that have very, very long roads to profitability. So I talked to Renaissance about this. Peloton loses $200 million on $1 billion in sales. You can get away with that for a certain period of time, but when the market hits the skids, people get nervous about saying, okay, the profitability path is how far out there? And I think that's what we need to concentrate on. Remember, there are people out there, retail interests, that are going to buy Peloton. It sounds like a terrific company. They've done a wonderful job building it. But the question is, what's the right price? Nobody's saying Peloton's got something wrong with the company. It's what are you going to buy it at? And is it going to show a path to profitability a few years down the road that I can clearly have confidence in? And that's what gets the IPO people going crazy, because they have been pushing back for a couple months. The prices are too high. Smile Direct, look, a wonderful company. It's done fine. But why did they price above the range? And they really got slammed. And when they see the model's not working, the path to profitability is not there, investors pull back. So we'll see what happens with Peloton. But again, it's how much, not the company, how much you're willing to pay for that future potential profits that are still not there.
Hans, a lot of focus, especially in the last couple of days, on dual-class share structures, especially with everything that's gone on with WeWork. We've had quite a number of companies go public that have had this type of structure in place. Peloton joins that list today as well. As someone who is invested in so many different startups, Peloton included, how are you thinking about that structure? And do you think the time is coming where it actually starts to go away?
Right. I think that structure works for certain type of companies. I think John mentioned earlier on CNBC that he raised quite a bit of money to get here, and his shares quite diluted. So he has about 6% ownership on IPO now, and in general, CEOs at this stage tend to have 10% or more. So you want to have a chance to be able to be in control of the company and run the way as he sees fit, and his stock record has earned him a right to do that. And back onto the losses, in this market, we completely understand how institutional investors are worrying about companies go IPO with losses. John also mentioned before that he spent $50 million to build a studio in New York, another $50 million to build it in Europe. The one in New York has multiple studios streaming for multiple different devices. So he is definitely investing aggressively for the future.
All right, Hans, we're going to watch it. Thanks for helping us set the stage for it. By the way, Bob,
Peloton is a two-time CNBC Disruptor 50 company. Our team in CNBC, please, I'm making sure. I'm looking out for you guys. Yes. We know all about Peloton, and highly recommend you check our CNBC Disruptor list. A lot of very successful, smart companies, and a lot of people at CNBC work a lot to get that list out to you. You want to know what the cutting edge is? I read it. I look at it carefully.